Good morning. Thank you for joining us at this trading update for ICG Enterprise Trust, covering the 3 months to the 30th of April 2023. My name is Chris Hunt. I head up shareholder relations here, and I'm delighted to be joined by one of the portfolio managers for ICG Enterprise Trust, Colin Walsh. During our presentation today, we're going to give a quick review of ICG Enterprise Trust's strategy and then a look at the performance of the company over the last 3 months. For those of you who wish to ask questions, you can do so through the portal, and we will take questions at the end. At which point, Colin, I'll pass over to you.
Fantastic. Thank you very much, Chris. So first of all, we'd like just to recap our investment strategy. This will be familiar to many of you on the call. But just to, I think it's worthwhile, we think it's a key point of differentiation of ICG Enterprise. Critical sort of overarching theme is we're focused on generating attractive risk-adjusted returns. And our focus strategy is critical to achieving this. If you like, the investment strategy is a recipe for generating those superior risk-adjusted returns. Over the years, we've tweaked and refined this investment strategy to reduce the inherent risk of private equity investment, but without sacrificing the outsized returns you can get from private equity. And this slide shows you the different components of our investment strategy. And in particular, its focused approach. So first of all, we focus only within private markets on buyouts, and within that on developed markets. We have a preference for mid to large cap deals and funds. And we also place a great emphasis on manager quality and invest in top tier funds, funds which have experience of investing through different cycles and have a demonstrable track record of success. And critical also to our strategy is the concept of defensive growth, and that's the ability to select companies which have the ability to grow even in difficult economic environments. It's also worth noting what we don't have exposure to. We don't invest in venture, we don't invest in growth equity, which have proven to be very volatile in the current economic environment. And we gain access to the asset class through a combination of primaries, secondaries, and co-investments, each of which have complementary return profiles. We recently had a Capital Markets Day, and one of the things we covered at that Capital Markets Day was some of the underpinnings. We went through some statistical analysis to demonstrate why this approach works particularly well. And we think it's a unique investment strategy in the listed private equity space, which is very well suited to a perpetual vehicle focused on generating compounding returns over a multi-year time horizon. So moving on to the next slide. We'd like just to cover our recent quarterly announcement. So yesterday, in advance of our annual general meeting, we announced our Q1 NAV. It showed portfolio growth of 0.5% in local currency terms, and that reflected a NAV per share of £18.76. Largely due to currency, and in particular the appreciation of sterling, the overall NAV fell by 1.1%. So what we're seeing in the market at the moment, it's a very cautious market. There are relatively low levels of activity. You can see that reflected in broader M&A volumes. However, one thing I would add, and this was something again we covered in our Capital Markets Day, was that our focus on the mid-market means that we've still seen steady realization activity because the levels of the volumes within the mid-market have been less impacted than some of the large cap funds. And we believe that our portfolio, which as I outlined in the previous slide, which has been built to demonstrate defensive growth, is showing its resilience. We've continued to exercise our investment program in a very disciplined and a characteristically cautious manner. And in particular, we made commitments to 2 of ICG's flagship strategies. That's our Mid-Market Europe Fund, which focuses on structured equity transactions, and ICG Strategic Equity, which focuses on secondaries. And for those of you interested, David Lomer, one of the managers of ICG's flagship Europe strategy, gave a very good overview in our Capital Markets Day of ICG's differentiated investment approach. We've also reinvested alongside a number of existing managers, in particular Hellman & Friedman and Cinven, and we made a new commitment to a US manager, Audax, to their latest flagship fund. We're continuing to see an attractive pipeline of opportunities. It's worth noting that when we make primary investments, that we're in a sense sowing the seeds for our future investment portfolio. So future returns from our primary portfolio, but also the optionality of being able to invest alongside those managers in some of their best ideas through direct investment. And we think that the current volatility that we're seeing, that often results in a very positive investment environment in the years to come. So we think the next 2 to 3 years could be a very attractive time, a very attractive investment environment. So moving on to the next slide. This just gives a few of the highlights from the last quarter to the 30th of April. As I mentioned earlier, current NAV per share is £18.76, and it's a total NAV of 1.3 billion. We're proposing a dividend of 8p per share for the quarter, and there's an intention to pay at least 32p for the full year. We've continued our share buyback program, which we launched last year. We repurchased £3.1 million worth of stock in the quarter. And despite a very quiet market, full exits generated 52 million. That's out of the 68 million you can see on the slide of our total proceeds, at a 20% uplift to carrying value. And that was at a 4.2 times multiple of cost. So we see this continued trajectory of realizations at uplifts as validating valuations underpinning our NAV. And we're pleased to see that there's been continued liquidity in the portfolio, despite, as I mentioned earlier, a quiet market for deals. Moving on to the next slide, where we provided a bit more detail on portfolio activity. And I think here you can see the benefits of our breadth, and in particular our approach of accessing the market through a combination of primaries, secondaries, and directs. And as you can see, ICG managed investments represent 30% of the portfolio today, broadly in line with our plan, which we consider to be, and we consider this ICG access to be a core advantage of being on the ICG platform. And much of the exposure that we have, much of the ICG managed portfolio is through direct deals and secondaries. You can see too that 60% of our new fund commitments were to ICG managed funds. Total proceeds, I noted earlier, 68 million, and they're balanced between primaries and directs, with a small inflow also from our secondaries portfolio. But I thought it'd be worthwhile spending a little bit of time on the largest realization that we had in the quarter, and that's Endeavour Schools. So Endeavour Schools was our third largest investment just before it was realized, and that was, you'd have seen that in the January 23 announcement. The sale was announced in February, just after our year end. This was a deal where we had exposure both directly and through a fund investment, and that was alongside a US-based manager called Leeds Equity, with whom we first invested in 2018. Endeavour, it's actually a relatively simple business to explain. It's a US-based private school provider. It focuses primarily on early years education, and in particular Montessori schools. And it's grown from a little over 30 schools when we first invested to over 100 today. And it's a really good exemplar of what we look for in direct investment. First of all, the US school space is a very attractive market. It's incredibly fragmented, and there's plenty of opportunity to add value and improve the business by acquisition. And increasingly, there's a benefit to schools combining into larger groups. The company is a leader in its regional markets. It has an incredibly strong management team, which has been very adept at making all of these combinations and expansion work. It's a highly cash generative business model, and it's demonstrated the ability to grow through a difficult economic environment. So many of these schools were trading during the GFC. So when we conducted our initial diligence, we were able to vouch that and to see that. We also saw that even through COVID, and we've seen it in the way in which the schools have recovered since COVID as well. I mentioned earlier the importance in our strategy of selecting the right managers. And again, this is a really good example of backing a manager with a very long track record of success and a very strong domain expertise. And it's been fantastic to see how this company has managed through and recovered very strongly from what was literally an unprecedented crisis. And COVID was a time, we never modeled a scenario where every school would be shut at the same time. But a combination of a strong manager and an excellent management team has allowed this business to emerge stronger and ultimately to give us a very successful realization, even during a time of muted deal activity. Next slide, we're just going to take a look at the portfolio composition. And I think the key takeaway from this is that our portfolio at the moment is broadly consistent with our medium-term objectives. There's a good balance between primary, where we're aiming for roughly 50% of portfolio exposure to come from, and then a balance between directs and secondaries. And it's also worth noting that in the 7 years since we joined ICG, we've successfully increased our US exposure, and that was a core strategic aim over the last few years. And that geographic expansion has been very accretive to our performance. If you think back to our strategy, it's allowed us to broaden our range, if you like, our addressable market of top-tier managers. You can see too that we've got very low levels of trust level leverage, and broadly speaking, we're fully invested. So we feel good about how we're positioned, but of course, we remain very conscious about the environment we're facing, in particular rising rates, and a broadly uncertain macro environment. Just like to spend some time now on shareholder return. That feeling of that we feel well positioned gives us confidence not only to invest for the future, but also to maintain our shareholder returns policy. The board, as I mentioned earlier, has declared an 8p interim dividend for Q1 and intends to pay at least 32p for the full year. And that would represent an increase of 6.7% over financial year 23. The buyback programme is continuing. We've returned £7 million to shareholders in 8 months since the programme has become active, and that's at an average discount of a little under 41%. During the quarter, buyback and dividend reinvestment had a positive impact on our NAV per share total return, and we believe that shareholders are beginning to see the economic benefit flowing through as a result of this policy. And I think we also believe that it creates a better functioning market in our stock as well. So turning to liquidity, we have £195 million available, and as I noted earlier, very little net debt. We've commitments to funds of £419 million in their investment period, and a further £126 million to funds outside their investment periods, which are much less likely to be called. So that makes us overall very comfortable with our level of commitments, given our liquidity position. And as we announced a few weeks ago, we entered into a new borrowing facility with 2 leading banks at the end of May on very favourable terms, which extended the maturity of our facility to May 2027. Turning now to our track record. Obviously, this is only one quarter, and for those of you who've met us, you'll know that we will always point out that ICG Enterprise is a long-term investment. Over the last year, we've generated 8.3% NAV per share total returns. But as you go out further, over 3 years, we've generated 21.6% on an annualized basis. And over the last 5 years, 16.2% on an annualized basis. And we believe that our performance really should be judged against this sort of long-term investment performance. And with that, I think I've referenced it a few times in this discussion. We held our inaugural Capital Markets Day a few weeks ago, and that gives you a much more in-depth guide to our strategy and some of the underpinnings behind it. It was a great chance for us to engage with some of our combination of our shareholders and other stakeholders, and we covered a number of key messages. And I wanted to end this call just by reiterating some of those messages. First of all, ICG Enterprise, we believe, is a very clear investment strategy. It's centred on delivering defensive growth over the long term. To achieve this, we have an actively managed, differentiated portfolio of private equity-owned companies focusing on the US and Europe. And in order to be able to do this, in order to be able to source, execute, and manage these investments, we have a dedicated investment team, the only dedicated investment team in the sector, based in both London and New York. And that investment team benefits from the ICG platform, from access to our managers' deal flow, as well as many of the deep institutional relationships that ICG has with a global group of leading private equity managers. And finally, and critically for our shareholders, we take a disciplined approach to capital allocation through reinvesting, dividends, and buybacks. So this is very much a long-term proposition. So whilst Q1 was relatively muted in terms of activity levels, we're very confident in this approach. And with that, we would be very happy to take any questions through the portal.
Thank you all very much for joining, and we look forward to speaking soon. Thank you.
Thanks very much.